Welcome to our Center of Global Finance seminar, regular seminar actually. And I'm actually in Victor's place today to chair today's seminar. We are going to have basically two macroeconomists who are going to present. Particularly Dr. Lucy Barros, who is going to taking the lead of the presentation, and those colleagues are from Swansea University, and for people who know the UK system, I mean Welsh system actually. So Dr. Lucy, so I'm trying to look at this short bio. Dr. Lucy actually is a lecturer in the economic department, and they have a research center as well. And Dr. Lucy actually, Lucy graduated from Oxford University and then obtained her PhD from Cardiff University. And I looked at this information actually, which is interesting to me. I saw shadow banking system in China, and that is something that I have been keeping on watching for very long. And Lucy has published in some well-recognized journals, such as Regional Studies and Economic Modeling. And we also have today here, we also have Dr. Rosen Chowdhury. I hope I pronounce the last name correctly. Yep. And Rosen, I think Rosen did his master from University of Nottingham, and then he did his PhD from University of Dundee. And now I think Rosen is a colleague with Lucy, so you work together in the same institute department. And I can see that Rosen has done quite a lot of things on macroeconomics and has published in various journals, including Journal of Macroeconomics and Scottish Journal of Political Economy, etc., etc. And by the way, I really like the Scottish Journal of Political Economy, but I think they downgraded this journal. But they should be. It was a very good journal, you know. So it has a very good history. Now, so I understand that after Lucy's presentation today, we are going to have a formal discussion, and the discussion will be provided by Dr. Aisha Demer, who actually was our previous colleague here at SOAS. So thank you, Aisha. Thanks for offering this. And I think we will have maybe 40 minutes presentation. And then after that, maybe Aisha can discuss the paper maybe within 10 to 15 minutes. And then we open the floor to the audience. We have the normal Q&A sessions. And then I understand that the presentation today, as you can see, is about one of the monetary policy transmission mechanisms, and that is the bank lending channel. And we have seen so many things in our daily life. And think about the financial crisis, think about COVID period, and think about very recently, the UK mini budget, announcement. So we did see quite a lot of monetary policies, the changing of it, high inflation period, etc., etc. So I have seen some papers on those transmission channels. To be honest, I didn't see anything that makes the connection between monetary transmission mechanisms, particularly bank lending, and the geopolitical risk. So I think you are going to talk about this based on the Turkish economy, right? And which is even more interesting if we think about what happened maybe just 2 days ago, the election. So very interesting. So I'm very keen to hear how you can make the connection between monetary transmission mechanism and the geopolitical risk. So I think now I can give the floor to you. Maybe one thing, so during the presentation, if participants have any comments or you want to interact with the presentation, etc., you can use the chat function. So we will collect those questions at the end of the presentation. Okay? So thank you very much. Lucy, the floor is yours.
Thank you, Hong. Thanks for that introduction. And can everyone see my slides okay?
Yes.
Is that sharing successfully? Okay, brilliant. I'll just get straight into it. So, yes, this is joint work with my colleagues, Rosen, who's here, and Dilshad at Swansea. As Hong said, that we're in the economics department. We have a Center for Research in Macro and Macrofinance. And the working title of this paper is Geopolitical Risk and the Bank Lending Channel, Evidence from Turkey. So I say working title because this is quite new work, newly completed. And so it's a great moment for us to be presenting it to you. And for that reason, we're very glad to have the discussant and to have all your feedback as much as possible. So please don't hesitate. Yes, to situate this in the macroeconomics literature generally, as Hong mentioned, this is about the monetary policy transmission mechanism, and specifically whether these channels are state dependent. And the channel we're focusing on in particular is the bank lending channel. And we're asking whether this is dependent on the risk state that the economy's in. Not just any kind of risk, but geopolitical risk or uncertainty, as measured by the indicator that's been put together by Caldara and Iacoviello. So this is really talking about geopolitical risk as in the threat of international conflict, or anything related to kind of international tensions that would disrupt the peaceful course of events, violence, terrorism, and so on. And our contention is that if we do find that the bank lending channel for monetary policy is dependent on geopolitical risk state, if we find that state dependence, then that's something that regions that are prone to this kind of risk should be factoring into their policy design. And so for that reason, it's going to be of great interest to policymakers. And our aim in this work as well, while we're doing this investigation, we really want to avoid some of the key empirical issues that work on this kind of thing tends to encounter. Mainly, we're looking to account for structural breaks in the data, as well as the usual problems with endogeneity and simultaneity and so on. And we think Turkey is a great country case study to look at in this context. It's got its fair share of geopolitical tensions, really because of its geographical location, its ideological and ethnic makeup of the population, and also because it's a prime candidate to see a bank lending channel in operation. And I'm going to talk more about why that is. Okay, so to recap a bit, I suppose, about the bank lending channel to get everyone's minds into the right place. This channel really rests on the presence of credit market imperfections. So, we've got asymmetric information between borrowers and lenders. And this creates, we've got an imperfect contract enforcement as well. It creates this wedge between the internal and external cost of funds. And this wedge, this external finance premium, is then sensitive to monetary policy, right? So if we have a monetary policy tightening, then the external finance premium is going to go up, either because of the impact of that on borrower finances, or the impact on lenders' balance sheets or lender position. So that's the bank lending channel that we're gonna be focusing on in this work. So the idea is the old version, or the original version of this, works as follows. You've got your monetary policy tightening, which causes reserves and deposits to drain from the liabilities side of the bank's balance sheet. And then the bank has some options about how it can respond to that. They can either substitute for those lost deposits using other types of liabilities, sort of uninsured liabilities, or it can reduce its assets. So on the assumption that these uninsured liabilities are more costly to obtain for the bank, or also that they could turn to wholesale funding markets, but that they'd also encounter an external finance premium there, and that would also be sensitive to monetary policy, right? So on that basis, we think that after a monetary policy tightening, the bank is more likely to reduce its assets. And the theory is that of the assets on its balance sheet, they're going to reduce their loans more than they would reduce securities, really because loans are riskier and less liquid. So that's how it's working. You've got your monetary policy tightening, and you've therefore got banks reducing their lending. And this lending reduction then obviously is transmitted to the real economy, because there are borrowers in the economy who are dependent on those bank loans. And so this is a channel for that monetary policy tightening to affect the economy that is over and above the usual channels, such as the interest rate channel. Okay, so why would we expect this to operate in Turkey? Because there's been literature that said for various places, it's less important. It's as follows. Okay, so based on the last slide, we could summarize the conditions we're looking for an operational bank lending channel here. Of course, we need our bank-dependent borrowers. We need we need these liabilities not to be perfect substitutes, right? Deposits and reserves not being perfect substitutes for other types of liabilities, wholesale funding, uninsured liabilities. And we also need the banks on the asset side to be holding loans and other assets which aren't perfect substitutes. And these conditions are all met in Turkey, right? It's a growing economy, with a very developed banking sector, but capital markets not so developed. So banks are making up a lot of the financial system, or accounting for 90% of the assets, and they still hold a lot of deposits on the liability side, and they also rely on wholesale funding in foreign exchange. But a really key aspect of this as well is the private sector bank dependence, right? So you've got this strong link from the bank loan supply to the real economy, because pretty much all the private sector loans are being issued by banks, not all, but a good chunk of them, and a lot of them are going to SMEs as well. So the other aspect, or really our key interest here, is the dependence of this channel on geopolitical risk conditions. Okay, so we think that the channel is likely to operate in Turkey, but we think that there may be reasons why its operation might depend on geopolitical risk. Okay, so there is, of course, some other literature now, quite a growing literature, on the idea that monetary policy transmission channels more generally break down in periods of high uncertainty. Right, so we'd like to explore this idea for the bank lending channel in Turkey. And the reason why we think it's likely is that this channel it relies on the existence of these financial frictions, as I said earlier. And there's good reason to think that the financial frictions themselves would vary with the risk state, right? Because it may be that in a high risk state, the market fundamentally changes the way it looks at creditworthiness of borrowers, right? So the idea here is that in a high geopolitical risk state, external finance premiums are going to rise for reasons that have nothing to do with monetary policy, right? So because of this risk, all lenders, they sort of shift into a more precautionary mode, right? So they take a more precautionary stance to borrowers, and this represents a shift, a fundamental shift in frictions. And this could well mean that lending would become unresponsive to a monetary policy expansion, right? So this is what we want to explore here. Yes, so we've already listed the reasons why we would expect in normal times there to be this operational bank lending channel in Turkey. But here's our hypothesis that in a high GPR state, GPR being geopolitical risk, we think Turkish banks would become very, very precautionary, and loan supply would become unresponsive to a policy stimulus. And, actually, this would result in the same outcome, but wholesale funders of Turkish banks would also become highly precautionary. So banks' own external finance premium would rise and then become unresponsive to a monetary policy stimulus, and hence, bank lending would also fall and become unresponsive to policy. And yes, we're going to be looking at geopolitical risk as measured by this Turkey country indicator, which offers some interesting exploitable data variation we're going to have a look at. And I'll talk more about that indicator presently. Just giving an overview here of what we're going to do. Our research questions are here. We've got two, really. And the first is this overall question of whether the bank lending channel depends on the state of geopolitical risk. The second is more about bank characteristics. There's plenty of literature on the bank lending channel that looks at whether bank characteristics are going to affect its strength, the strength of the channel. Do features of a bank, like what it's got on its balance sheet, affect how monetary policy shocks are propagated to the real economy? And generally, that literature finds that bank characteristics do affect that strength. So what we then want to ask is whether that general result depends on the state of geopolitical risk as well. So the first of these questions we're going to address with a macro level analysis, where we're going to use local projection methods. We're going to look at some regime-dependent impulse response functions, where our risk regimes are going to be identified using a smooth transition model, where the geopolitical risk indicator is the threshold variable. And the second question we're going to look at with a bank level panel analysis, a dynamic panel. And instead of using system GMM, which is more common, we're going to use an estimator that's robust to structural breaks in the panel. That's an entity-specific structural breaks. The Double-D GMM estimator, which is my co-author Rosen's contribution in this 2018 paper. So I'll talk more about that later on. But yes, both of these empirical strategies are really designed to deal with the issues that can arise from misspecification if there are breaks in the data generating process. So this is a key issue in how we've designed this study. To give a preview of our results, we find in the first section, so using our aggregate time series methods, we find that the bank lending channel is indeed contingent on the geopolitical risk state. So that's the main thing to say there. So yes, we find in normal times that the bank lending channel is propagating a monetary policy shock. So if you have an expansionary monetary policy, then that is going to be transmitted to the real economy via bank lending. But when geopolitical risk is high, that channel breaks down. All right, and in the bank level analysis, we also find a similar result. We find that lending becomes unresponsive to monetary policy when geopolitical risk is high. And we find that, in line with the rest of the literature, really, we find that in normal times, bank characteristics do matter for the strength of the bank lending channel. But in the high geopolitical risk state, they don't matter very much. They have a very marginal effect. And what we actually find is that in a high geopolitical risk state, all banks are effectively weak. In the sense that they aren't resistant to shocks, regardless of the strength of their balance sheets. So this is where we're going with it. And our contributions, to summarize the contributions of the paper, first of all, we haven't seen any work on state dependence of the bank lending channel based on geopolitical risk. It's not been done, to our knowledge, elsewhere, and it's certainly not been looked at in the case of Turkey. So that's the first thing. There's other work, obviously, that's looked at state dependence of monetary transmission mechanisms more generally, on uncertainty, different types of uncertainty. And there's work that's looked at the state dependence of bank lending, but not the state dependence of the bank lending channel of monetary policy. So yes, we also do this combined approach where we do a macro time series analysis and a bank level analysis together. And this is because we think that together they are stronger, because while they're both perfectly good approaches, they complement each other well. For instance, the micro level approach, you can look at the impact of the monetary policy shock on bank lending, but it's harder to show the impact of bank lending on the real economy, right? So you need, for that additional aspect, you need the macro part. So that's what that adds there. And of course, the micro level study gives a lot more granular insight than the macro study can. So together they're stronger. That's what we think. And very few people have done that. And finally, yes, we're really trying to address these issues of structural breaks and hopefully get some robust results that then policymakers could use to calibrate state-dependent models. So those are our contributions. And outline, I won't talk about this, but just so that you know what's in store, you've got two sets of empirical results coming, a macro level and a micro level analysis, and then, I'll conclude. So briefly on related literature, the empirical literature on the bank lending channel, it falls into these two broad categories. So you've got your aggregate time series approach using a mix variable. And we use a mix variable as well. And I'm going to explain what I mean by that when I come to talk about our approach. So this mix variable is really there to identify the bank lending channel as opposed to other transmission channels. And you've got obviously Kashyap et al. 1993 who kicked that off. And these other papers as well. You've then got your second strand, which is GMM panel estimation of these reduced form models, where you're regressing loan supply on bank characteristics and then some controls, some macro level controls as well. And there's lots of papers in that vein. And as I said earlier, they tend to find that bank characteristics matter for the strength of the channel. So the panel approach, as I just said earlier, we can identify the effects of monetary policy on lending, but you can't really track that through to impact on the real economy. And both strands here also traditionally have mostly not looked much at structural breaks, and they also have tended to assume a linear framework. So more recently, there has been much more work on the monetary transmission mechanism, thinking about nonlinearity in that. So I've put, obviously, I could have put many more papers on this slide, but some I've put here are papers that have looked at uncertainty regimes. So they tended to find that in high uncertainty regimes related specifically to policy uncertainty, when policy uncertainty is high, then monetary policy is dampened, right? Its effects on the economy are dampened. And yes, so that's a sort of macro level kind of literature. And then you have got some literature on the state dependence of the bank lending channel as well. So these papers I've put here, they've looked at whether the bank lending channel depends on the state of the business cycle. And they generally find, these papers, that it does. Okay, and I've got a paper there by Dilshad and Rosen, who are my co-authors on this paper. This Jahan et al. 2023. There's a recent paper of theirs on that, on the UK. So that was a really quick run through of the literature. I'll just have a sip of my water. And now we can get into our first set of results. So the first study that we've done, or the first piece of analysis, is this macro level analysis, as I said. And we use data on Turkey between 1998 and the first quarter of 2020. So I suppose this ties into what Hung said earlier at the beginning in her introduction about recent developments in the last few days in Turkey. This certainly isn't really included in our sample, and in fact the last 3 years aren't. And, perhaps we can talk about this in the discussion, but I think monetary policy in the last 3 years in Turkey may be something we'd rather not discuss. But anyway, we can talk about that later. So here's our data. We're looking at data on real GDP, inflation, the discount rate, the nominal exchange rate, and our mix variable, which, as I said, is key to identifying our bank lending channel here in this study. So by the mix variable, we mean the ratio of bank loans or loans by depository institutions, traditional banks, to total loans by all financial intermediaries, so banks and non-banks. All right, so the reason why this ratio is important is that we want to isolate movements in this ratio due to monetary policy, because we want to see an impact on bank loans, which isn't shared by other types of lenders. Right. So the idea is that, say there was some kind of monetary policy effect via the standard interest rate channel. This would have demand side effects. So, if all borrowers start demanding fewer loans, then that would be expected to affect banks and non-banks, and we wouldn't expect this ratio to move. So we want to isolate an effect on the bank lending channel where, you know, for the reasons discussed, banks, right, depository banks are changing their lending behavior in a way that these other institutions are not. Okay, so we've smoothed all of these series except for geopolitical risk, which I'll talk about in a minute, using the Perron and Wadder technique. So we Kalman filtered them, assuming endogenous breaks in mean and trend. And then we've got our GPR indicator, our geopolitical risk indicator, which is then our transition variable. So that's, as I said, this country-specific indicator from the data set collected by Caldara and Iacoviello. More about that indicator. So geopolitical risk, as I've said, it's you know, it's distinct. It's related to adverse threats and events about war, terrorism, international tensions, conflict, right? So this is what we mean by geopolitical risk or uncertainty. Worries about those things. And it's one element of this uncertainty trinity, as Carney said. It's become sort of a common phrase. So the other two elements of that trinity are this economic uncertainty, or economic and financial uncertainty, and then policy uncertainty, which has also attracted a lot of attention, particularly since the Baker Index came out a few years ago. So geopolitical risk is distinct from these, and that makes it interesting. So it's different in the sense that it doesn't move when, say, the VIX moves. You know, when economic uncertainty is high, geopolitical risk, you know, need not be. And when policy uncertainty is high, geopolitical risk also doesn't move. You know, for instance, you know, if you've got presidential elections, policy uncertainty responds, but geopolitical risk doesn't. So yes, it's more likely to capture events that are unrelated to the economy. So it's exogenous in that sense. It's a newspaper-based index. And so, of course, it reflects the perceptions as they are in the press, right? So what we hope is that this reflects relevant views of the public and policymakers and, you know, people generally. But it is a perceptions-based thing. It's a dictionary-based search of digital archives. And they look for bigrams, so they look for these associations of a topic word and a threat word. So that's designed to be more robust to the possibility of false positives. So the topic word might be war, and the threat word might be risk. You know, so war and risk in the same sort of vicinity. That counts as an instance of geopolitical risk. And that's how the index is compiled. And yes, channels for this kind of risk to affect the macroeconomy. You obviously got the effect of war or of conflict on the capital stock, on people, on lives. You've got higher military spending. But I've emphasized on the slide this increase in precautionary behavior, because that's what we think is really relevant for the banking sector and for lending behavior here. And here is the index, the raw index, that we've used as a thresholding indicator. So as you can see, it's fluctuating quite a lot. You've got these big spikes. You've got a big spike in 2003, which sort of lines up with the Iraq War. And you've also got quite a lot of smaller spikes. These seem to be related to they're related to the Kurdish-Turkish conflict. So you've got quite frequent terrorist bombings. You've got the Istanbul bombings in 1998 and 99. You've got then a spate of smaller shocks here, which relate to further bombings on Turkish soil, generally attributed to the PKK, Kurdish separatists. And then you also have Turkish incursions outside to Syria and Iraq, also related to these Kurdish tensions. So this is our index for our transition variable. All right, so as I said, we're going to be using nonlinear local projection IRFs, but it's easiest to start by explaining the linear form of this, which many of you will be familiar with. You've got a sequence of regressions here in equation 1, really. So you've got an endogenous variable x, and it's being regressed on its lags. And then, this sequence of this equation is sort of a sequence of regressions that's being sort of lagged forward one step ahead each time. And yes, the idea is that this is a way of getting the IRFs that doesn't require you to specify the underlying, the true data generating process. So you don't need to estimate a var and invert it to get the impulse response functions. And that makes this way of doing it more robust to misspecification, because especially at longer forecast horizons, the var approach can be problematic in that way. So once you've estimated the sequence in equation 1, you're in a good position to get the IRFs, right? So you need to find the structural shocks, and then you can obtain the reaction of the system. So how to get the shocks is also, of course, the key point. We could get that from a var model. We actually choose to use instrumental variables. So we estimate equation 3 by 2-stage least squares to get the monetary policy shock, which is really the shock that we're interested in here. We're not looking at any other shocks. So we estimate this equation, which is based on a reaction function for monetary policy. And you'll notice it includes the forward and the backward lags of inflation. The forward lag in order to capture the exchange rate, right? Which we think that the Turkish Monetary Policy Authority is also taking account of. Okay, sorry. Have another little drink of water. So the nonlinear local projection IRFs. As I've said, our aim here is actually to think about regime dependence. So we want to see whether the effects of monetary policy shocks, especially on this mix variable, is different in times of low geopolitical risk or normal times, as opposed to times of high geopolitical risk. So what we do is we extend that framework, that linear framework, to accommodate this kind of non-linearity. And we follow Auerbach and Gorodnichenko in estimating this smooth transition model, this logistic function. So they use it in the context of fiscal policy. We're using it in a very different context here. So we estimate this model in equation 4, and when f of z is 0, or z is our geopolitical risk variable, I should say. So that's how our transition function's working. It's dependent on geopolitical risk indicator that's been normalized. So when f of z is approximately 0, we're in regime 1, which is the high geopolitical risk regime. And when it's approximately 1, we're in normal low political risk, geopolitical risk regime. And then, of course, depending on which regime we're in, which would be told by the transition function, depending on which regime we're in, we're going to see different economic outcomes. And then we can estimate the IRFs dependent on the regime, right? So having estimated the sequence of equations in equation 9, we would have these coefficient matrices that would allow us to do that. Right, and this is our resulting smooth transition probability that we get from estimating that model. And as we can see here, I mean, there are two things to note. Mainly, one, we do identify regimes of high geopolitical risk here, and times when we're not in high geopolitical risk as well. And also, the regimes that we identify are sensible. You know, they fit with what we observe. So you've got these bombings, which I mentioned in 1998, Istanbul bombings. You've got high periods in 2003. You've got this other spate of bombings and shocks, sort of terrorist related, that we mentioned. You've got the Turkish incursion into Iraq in 2017. So it's giving us something sensible. That's really the point here, that we've identified these regimes. They exist using our model. And then we can look at these regime-dependent local projection IRFs. So this is showing us what happens after a 1 standard deviation monetary policy expansion in both regimes. And you've got regime 2, which is the normal times in red. You've got regime 1, which is the high geopolitical risk state, in blue. So that's what you've got there. And if I first of all sort of show you or direct you towards the mix, first of all, have a look at these mix responses. So if we take regime 2 first, the normal times, what we can see is that this expansionary monetary policy shock is having the expected effect on the bank lending. All right, so there is a bank lending channel here, in the sense that this variable, the mix, this ratio of bank lending to total bank and non-bank lending, it's responding a lot, right? So the mix is rising on impact, and then, you know, staying high for a good 10 horizons, right? So it's sort of a large and persistent effect that the expansion is having. And then you can see this being passed on to the rest of the economy. You know, it's showing up in GDP, and you get a GDP expansion, you get an inflation response, and you get an exchange rate depreciation, and it's all just as we'd expect. But in the high geopolitical regime, in the high geopolitical risk regime, things are quite different. If you again look at the mix, you've got a very small impact response, and then it pretty much dies out very quickly. You know, so especially if you look at the lower bound, it's gone very quickly. The shock is dead. And yes, you get a lower response of GDP. I'm not sure that that the axes are very well designed on these charts to really bring out, but the impact on GDP is much lower. And so while you do have some kind of expansionary effect on the economy from the monetary policy shock, it's not working through the bank lending channel, right? So that's the point that these impulse responses are bringing out. There is regime dependence in the bank lending channel. Again, I've summarized that here on the slide. The additional bit of information is the specifics on the GDP response, which is 1.3 to 1.9 times higher in normal times than it is in the high risk times. Okay, so that brings us to our second set of results. I think we're doing okay for time. So our second analysis is, as I said, a bank level panel analysis. So our macro analysis was really about asking whether there are regimes in geopolitical risk, and we found that there are, and whether the bank lending channel is dependent on them. And again, we found that that seems to be the case. And the micro level analysis now gives more insight into how this bank lending channel is working, and also lines up with a lot of other literature on the bank lending channel, which takes this approach to the problem. You know, gets a bank panel and estimates a dynamic panel using system GMM. So our data for Turkish banks is from SNL. It's a balanced panel for the same dates, 1998 to 2020, Q1. Number of banks is 19. And our bank-specific variables that we focus on are these three. So we look at bank size, which is measured by the total bank assets on their balance sheet. We've got bank liquidity, which is the ratio of securities to assets, and bank capital, which is the capital asset ratio. And we use this Double-D GMM estimator, which, as I said, is Rosen's baby, really. Rosen and Bill Russell developed this estimator, and they've called it Double-D GMM. So the issue is this, okay? If there are common breaks in the data set, you know, breaks that are common, structural breaks that are common to all the entities in the panel, then system GMM can deal with it fine. You know, it can cope fine by putting in a time dummy. But if the DGP is as it is here, we've got entity-specific breaks, right? So bank-specific breaks in the data set. And that means that there are going to be mean shifts in the fixed effects. So that's this delta ITB that you've got here. The problem is, if there are if these kind of mean shifts in the fixed effects are present, then it's going to invalidate the standard Arellano bond and Blundell and Bova moment conditions that we've got here in equations 12 and 13. If we've got a scenario as described in this data generating process. So you can see that these conditions are no longer zero in this situation. But Rosen and Bill derived a couple of other moment conditions that would be valid in that scenario. When you've got these bank-specific breaks. And here there's the, you know, I've put the forward lag Double-D moment condition, because that's what we're using in this piece of work. All right, so it is going to be zero. You can see, you can have a look at their paper to see all the background. And yes, here the important thing to say is that the instruments and the estimation equation are both in differences, and that's why it's known as the Double-D GMM. We use the forward lag, so that's to say the instruments are the forward terms. And here is our specification. Because we're looking at the long run effects, we use a different specification. And yes, what have we got here? So L, our dependent variable, a difference lending. So L is lending. And R, big R, we've got our macro variables. Big R is our discount rate, our monetary policy variable. TGPR is Turkish geopolitical risk. We've also got GDP there to account for cyclical movements, you know, demand side effects. And then we've got our bank-specific variables I mentioned before, liquidity, size, and capital. And then we've got interaction terms, right? So we've got the bank-specific characteristics interacted with monetary policy changes. And finally, another set of interaction terms, which has our bank-specific variables interacted with monetary policy changes and the geopolitical risk variable. So these are going to be our focus. Okay, so how are we doing for time? We're pretty good. Nearly at the end. So our results Here you can see that monetary policy in general is significant and negative, right? So a monetary policy contraction is going to reduce lending. But importantly, when it's interacted with a high geopolitical risk state, so in a high geopolitical risk environment, monetary policy becomes insignificant. So that's one of the key findings. The other things to mention here are the interactions with the bank-specific variables. So as you can see, these interactions with liquidity, size, and capitalization, they're all positive and significant when they're interacted with monetary policy. So this is to say that if you're a bank with a strong balance sheet, you're better able to withstand a contractionary monetary policy shock. It's not going to affect your lending so much as if you're a smaller bank or a less well-capitalized bank. So that's in line with established literature. What's more novel here is the three-way interactions. Okay, and you can see that in the case of liquidity, it's insignificant. In the case of size and capitalization, it's significant, but the magnitude is very small, right? So if I go to my discussion slide, these are our conclusions here, really. I mean, I've said most of these things already. Contractionary monetary policy shocks do reduce lending for all banks, but become insignificant in a high GPR regime. There are modificatory effects of the monetary policy shock in high GPR regimes for size and capital, but the magnitude is small. So what we're concluding is that it's true generally that having a low size and low capitalization and low liquidity makes banks weaker in the face of monetary policy shocks. But in the face of two shocks together, this combination of a monetary policy contraction and high geopolitical risk, all banks are weak in the sense that, you know, even having a strong balance sheet isn't going to help you to resist that situation. Okay, so a very brief look at robustness. For our aggregate data, there are various things that we've done to check robustness. We've looked at different horizons in the local projection model. We've looked at different gamma values in the transition function. That's the transition speed parameter. And we've looked at using reduced form shocks from the LPIRFs. We've also looked at using shocks from a structural VAR, you know, with the usual recursive sort of ordering. And in all those cases, we find qualitatively similar results, right? So we do find that there's a bank lending channel in normal times, and we find that it disappears in high geopolitical risk regimes. So pretty robust in that sense. In the bank level data, in that section of our work, we've really got work in progress. So what we're intending to do is to use this approach that's been presented recently by Ditson and co-authors, where we can take account simultaneously not just of multiple breaks, but also of cross-sectional dependence. You know, so spillovers across banks is kind of contagion. This idea that, you know, an idiosyncratic shock to Bank I might well also affect Bank J, you know, so that would be interesting to look at. So that's our plan. All right, so let me wind up. Here are our conclusions. We've been asking, does the bank lending channel's transmission of monetary policy, does that depend on geopolitical risk? And we've found, using both our time series methods and our micro methods, that its magnitude diminishes when geopolitical risk is high. The regime-dependent local projection IRFs show that the monetary policy shock is being transmitted to the real economy through the bank lending channel in normal times. but that this channel becomes inactive in Turkey when geopolitical risk is high. And in our bank level study, we found that bank size and capital matter for the strength of the bank lending channel in normal times. And in the high geopolitical risk state, their effect is very small. It's there, but it's very small. And overall, our conclusion for policy would be that in the high geopolitical risk state, there's little scope for monetary policy to be effective. And that matters because it underlines what we already know, which is this is the politician's job to deal with the geopolitical shocks. But if they really want to stabilize the economy or allow monetary policy institutions to do their job, then they need to head off these shocks before they take hold, because once they do, the monetary policymakers' hands are much more tied than they otherwise would be. All right, so that's it, and I would love to hear our discussants' thoughts now.
Congratulations, Lucy. You went through the whole thing, whole presentation, and with some water. So thank you very much, Lucy. I think now, there's no reaction. So thank you very much, Lucy, for your well-structured presentation. So I saw some underlying theories. I saw innovative econometric methods. So Double-D GMM is something that I have not done by myself. So it's good to know. And particularly you carried out the empirical analysis by using both aggregate level data and bank level data, which is very good in my view. And well, I just throw out some general things for people to think about before I gave the floor to Asia. So now you found that when the geopolitical risk is high, the monetary policy does not really work well through the bank lending channel. So my first question is, how do we explain the bank's behavior facing those higher geopolitical risks? Why did they do that? Did they react similarly to some other uncertainties? For example, natural disasters, the earthquake, for example. How do we explain their behavior? So secondly, you mentioned at the end of your presentation, for policymakers, you actually hinted something, but I'm still thinking, what can be done, from the government's point of view or from the central bank's point of view? So I hope they know this, right? If they are aware of the weakness of monetary policy when uncertainty or geopolitical uncertainty is high. So what can be done from their perspective to secure that the monetary policy tools still, I think they aim to put them into the effect. So what can be done? How do they do in the time of higher geopolitical risk? So that's the general question. And then another question is why Turkey? So still, why Turkey? So I will leave this to for people to keep those in mind. And to the end, when Lucy is responding and Rosen is going to join us, to respond to the questions. So now we have Dr. So Asia, good to see you, and I'm sure you are familiar with the Turkish economy, so I'm very interested in hearing what you think about the paper and what are the further questions that you can raise for us to think further. So Lucy, can you please unshare your transparency? Yeah. And Aisha, are you going to share anything?
No, I'm not going to share. I will briefly discuss about the paper. Thank you, Lucy, for your presentation. And it was very interesting to see from my point of view a discussion about my country. What a hectic country! what a so adventurous country. I can. It's all because of geopolitical position of the country. So in this sense, your study is very specific to. It's a very specific case study. So one of my first comments will be on the generalizability of your conclusions, because Turkey has a very specific geopolitical position. But before moving on to all my comments, I will briefly discuss your paper. So your paper basically explores the relationship between geopolitical risk, bank lending, and the effectiveness of monetary policy in Turkey. You aim to investigate whether bank lending channel is dependent on the state of geopolitical risk, and whether bank characteristics play a role in transmitting monetary policy shocks to the real economy. You employ both macro level analysis using a nonlinear local projection impulse response functions, and also you use bank level analysis with a double difference generalized GMM, where you combine both macro and macro data in order to elaborate more on your results. And your findings suggest that bank lending channel operates more effectively during the periods of geopolitical risk, while its effectiveness diminishes during the high political risk regimes. And additionally, this study reveals that the bank characteristics such as size, capitalization have some influence on the strength of the bank lending channel, although their impact is relatively small during the high geopolitical risk stakes. In overall, the paper provides a comprehensive analysis of state-dependent nature of the bank's lending channel and its relationship with the geopolitical risk in Turkey. It emphasized the importance of considering the varying extent of financial frictions in market perceptions of the borrowers and bank network in understanding the transmission of monetary policy. My questions will be basically very in line with what Hong has suggested. First of all, I think on the theory side, there needs the relationship between bank lending channel and geopolitical risk regions is still, I think, more theory and foundation is needed in order for us to be able to see how theory works between these two variables. So let me read my notes here on the theory. And yes, so another comment will be on the geopolitical risk measure. It's a comprehensive. It's a very comprehensive measure. In your case, I couldn't get a clear picture on what you are measuring with geopolitical risks. And when you consider Turkey, there are many factors involved in the geopolitical risk. So I want to talk about this. You mentioned Kurdish problem, but Turkey has many other geopolitical risks imposed by, for example, regional conflicts. Turkey shares borders with countries such as Syria, Iraq, Iran, which have experienced ongoing conflicts, ISIS, Daesh, and they are all going through political instability. And Kurdish issue you have highlighted. So we have this Kurdish issue within country, and also the challenges coming from our borders. And of course, Turkey has one of the, I think, countries which is affected most by the Syrian civil war, because at the moment we have many refugees fleeing from Syria, and Turkey is hosting many of them. And because of proximity, we have to host many of them. And country has many other issues refugee-related challenges. The public has many security, safety, economic issues related with refugee problem, and relations with Greece and Cyprus. This has been a problem inherited from the last 3-4 centuries, and Turkey has had territorial disputes and strained relations with Greece and Cyprus, particularly regarding the issues such as maritime borders, energy exploitation rights, and Cyprus conflict. So these are all very major geopolitical risks imposed, which I don't think you have touched upon on your presentation. And these are very influential on our monetary policy, bank lending channels as well. Of course, political instability. The country has been going through big political instability, especially since 2016 coup attempt. It is a very important event that we experienced in the last 10 years in Turkey, that because we had an emergency state of like 2-3 years after coup attempt, where most of the judicial system, police, army dysfunction because of the emergency state declaration in many of the institutions in Turkey. So this is the role of this, is especially for the last experiences of the monetary policy. The effect of this COP and post-COP policies cannot be ignored within the context of your study. These are very important. Of course, terrorism we have, and it's another geopolitical risk in terrorism in the country, where we have some minor groups, and of course from borders as well. And we have problem with ISIS, we have problem with PKK, and these are major two terror groups which create conflict within the country. And of course, our relations with NATO and EU. Turkey's relationship with NATO and EU has experienced strains due to various factors, including human rights concerns, political disagreements, and different regional priorities. So these tensions can have geopolitical implications, Turkey's position in the international area. And I believe that your geopolitical risk measure is can be more comprehensive, and if you take into account these factors, you will have a more accurate geopolitical risk measure. So my first comment was on your theory, the theory that explains the mechanism between bank lending channel and geopolitical risk. So I think to me it was not that clear in the first bit of your presentation. I think more explanation is needed on the channels through which bank lending channel could affect geopolitical risk. So you could, especially for Turkey case, as you said that this is a new work, and this has never been, not many countries have this geopolitical risks like Turkey has. That's why I think this mechanism should be more clear, and we have to be able to see what are the factors through which bank lending channel can affect geopolitical risks. And the second one is on your measurement of your geopolitical risks, especially for the case of Turkey. I will also send my notes to you and all these risks that I have identified related with Turkey. Another, I think, very important factor especially for Turkish case is the instability of the central bank. I think this is as important as the geopolitical risk imposed on the bank lending channel for Turkey. For example, we have our central bank policies are, especially recently, for example, I will talk about them. which creates, I take note on them. Yes, here. So, first of all, in the last 3-4 years, we have frequent changes in our central bank governance, which significantly affected the capital outflow, capital inflow, bank lendings. So, for example, Murat Uysal in 2019 was appointed as governor, replacing Murat Çetinkaya. Naci Ağbal in November 2020 was appointed governor, replacing Murat Uysal. Şahap Kavcıoğlu in March 2021 was appointed as the new governor, replacing. So there are frequent changes in central bank governance which affect all these both central bank monetary policy and also bank lending decisions as well. So I can say that our country, relatively when compared with other, especially the European countries, have relatively more intervention to our central bank. And so, which of course all these changes and also interest rate policies, our interest rate policies, does not always align with what is expected to be done and suggested by the economic advisors. So, which create, of course, exchange rate stability problem, which that affects bank lending. For example, at the moment, before the elections, the amount of exchange, dollar exchange, was minus in the central bank. So there was no foreign exchange reserve in the central bank before elections. I didn't check the current state at the moment, but before 28 May, this was the case in the central bank. So these are all very important factors that affects bank lending decisions, and in addition to geopolitical risk. So this affects exchange rate stability, inflation control, and market confidence and credibility, economic growth and investment. So
Yeah, actually, that might be a good point. Just to intervene, just to say that for those very good reasons, we cut our sample in very early 2020 because we don't want to deal with this period of highly unorthodox monetary policy. And actually, our position on that is that it can't continue, right? So that's why we think, not only do we not want to deal with that period, but we think that period is finite, in the sense that markets are going to force monetary policy back onto an orthodox path at some point. And I think we've seen a lot of discussion in the media about that in recent weeks.
So yes. Asia, can you please finish up?
Yes. I think Yes. Actually, these are since I'm sure the rest of the audiences will have comments on your data and methodology. I just would like to talk more about the concept and the Turkish case, since I'm more familiar with those. So I will leave rest discussion to our other participants. Thank you very much, Lucy. Now I will send you my comments.
No, I thought, that would be great.
Thank you very much, Aisha. I think you provided a lot of details for us to understand this country, which is very, very important. So I understand that. Lucy, you said that you have a time constraint today, right?
Yes. Especially Rosen.
Yes. Yeah, I mean,
especially Rosen. Okay. Yeah. So that's fine. So
is it okay, Lucy? I contribute some, and you can take over from later on.
Great.
That will be very good for us, because normally our plan is from 1 to 3, so that we can open the floor, we can discuss more issues. So in that case, so I think Aisha has raised 3 issues: the theory, the measure, and the Turkish other instability or of other factors. So can I take one more before I give the floor to Rosen to answer, because I saw an urgent hand. Ines,
Hello.
show your hand. Yeah, please. Just be short, please. Yeah.
Yeah, it's just one question. Okay, so I'm Ines. I'm a second-year PhD student from Queen Mary University of London. I'm doing my research as well. My research is also related to the bank lending channel. So my question is, I just want to add to what Aisha said, but what's the relation that makes you think that geopolitical risk may affect bank lending? Is there any report that, like, for example, I want to give you a counter example. For example, the pandemic is an exogenous crisis. However, it affected bank lending. Yes. Yep. So we just want to find the setting, how pandemic affected bank lending, which will make us think that it may affect bank lending channel. This is my research.
Exactly. So I'll just give. So, Bo, shall we start answering the question?
Yeah. So I think we can. So Ines, just chat. Ines, you finished your question, right?
Yeah. That's
so
link, theoretical or maybe report, anything that makes us think that this may affect bank lending channel. And the other thing is about supply and demand side is not clear. Is it maybe caused by banks are reluctant to lend when other?
So you're asking about the identification problem.
Yeah.
These two, identification problem, yes.
Yeah. Okay.
Rosen is going to leave very soon. So let me give Rosen a few minutes to respond to the questions that we have already collected now, as much as you can, given your time constraints, and then leave the difficult part to Lucy, okay?
Okay.
So Rosen, so please.
Thank you. Thank you both, Aisha and Bo, for your comments, and lots of thanks to Lucy because she actually made the thing finish. Now I'll just start with your comments. First of all, I'll comment on the data. Now you say that there were lots of incidents. Actually, these incidents, as such as it's not only PKK. So it also covers. I think there was. It covers about the border clashes with Greece, because the fighter jet shot down by Greeks, and then later on the other side. And then if you go back, if Lucy later on shows, then you say that we don't include the incursion into Syria border clashes starting from I think 2017. So these are all included. So, for example, it's the border clashes that are going on with Syria. They are all included, and the fighter jet shot down by the Syrians in 2016. So if you see that, the geopolitical risk index goes up from 2016, and then incursion border fights with Iraq, so that the index jumps up. So all these things, it's not only within PKK. PKK was one of the main factors, but there are even within regional northern Iraq. I remember when we were plotting the dates, there was one wedding ceremony incident where I think 50 or 60 people died between two rebel groups. It was a bombing incident on a wedding event. It was a major thing, and at that time, the index went up. So these indexes are actually created by basically. They've got an algorithm. They basically take down the major events. So they have some words. They collect it from the major news sources within Turkey, plus the major newspapers such as New York Post, Chicago Tribune, and then the ones in UK. So the major ones. So it more or less captures when we basically look at the dates, what's happening, and so that's why we picked this. And
yes, and so, Rosen, can I just say as well, the fault is therefore my narrative of the index rather than the index itself. The index isn't skewed just to ignore everything.
What we can do is we'll basically put the dates in the paper, the major events. Because this goes to another thing that Bo, you asked, why Turkey? Now I think Aisha pretty much answered that in a way, because you see the position of Turkey. It sits between Asia and Europe. It's one of the oldest members within NATO. It's now a major economic power. It's a regional power itself, because it's whenever things go wrong in Syria or Iraq, and it's been going on from 2001 to 1990. So 1990, when the first Gulf War started, you see that wherever the jet planes, fighter jets of NATO base, it was in Turkey. 2003, it was again in Turkey. Syrian war, and then Turkey gets entangled with all these conflicts. And then she has her own internal conflicts. So that we thought that, okay, this is a prospering country within itself. It's an emerging economy, was growing fast. It has its bottlenecks. Plus, then again, it has this political side, shocks affecting exogenous shocks. Now, I think, Lucy, do you want to add anything?
No, I think that's covered it. We were asked why Turkey, asked about the geopolitical risk measure, which I think, I did a disservice to the measure rather than the other way around, and the instability of the central bank, which we've dealt with.
Yep. I think the other thing that you mentioned about, the changes of governors and all these things. Now, if you look, that I do agree with that. Turkey on paper says that it's an inflation targeting regime. Now, we don't buy that.
Rosen,
yep.
Actually, I have a very minor comment. For example, the events that we are talking about, for example, coup attempt, the change of the government system.
Actually, the 2006. Yep.
Yeah, let me explain. So the change of governmental system from parliamentary to presidency. So these events cannot simply be analyzed under one geopolitical index. These are all major events. And yes. I think
that is domestic. That is a domestic political movement. So, that's not geopolitical.
So if you look at their website, how they measure the index, these are actually accounted for. So whenever you have, let's say, coup happening, it goes up. So it picks up. So that's why this is one of the, this index is quite innovative. So it not only captures the internal events, such as you're saying that the military coup in, I think in 2016 or something, when I won't say, but there was a coup, and there was lots of, backlashes and people sent to jails and lots of other things. That part was captured. So if you have a look at, I think it's our fault. We should have included a proper paper rather than some slides. So it's my fault. I take my, but if you, we'll send the slides and we'll send the data link. So if you want to have a look and match it up, as far as we looked up. So Lucy, if you later on show them that the periods, we actually could cover those things. Going back to your question about all these changes that's happening in the central bank now, that takes us into a totally different domain. So you're then basically going into measuring central bank independence. So that's a totally different literature altogether. It's a totally different argument. But we are focusing on monetary transmission channel, but we do it from our results. If you see that, we can capture the monetary policy shocks properly. So we don't see any price puzzles happening. And if you go back to our impulse responses, one of the things that you mentioned about exchange rate, and I do agree that when Turkey's inflation was going up, the central bank, rather than increasing the interest rate, they basically reduced the interest rate. And that would have created a havoc on the exchange rate reserves. And if you go to see our slides, so what we find is that a decrease in interest rates actually reduces the Turkish lira's value, so which goes into economic theory. Basically, you can't do this continuously. So at some point, you have to stop this madness. I mean, to be frank. So, but then taking all these things, I mean, talking about independence, whether we should put a Turkish central bank independence variable into the picture, I think that wouldn't change too much. But it is an interesting thing, because Turkey tells itself that it's an inflation targeting regime, but we don't actually think so. It's a strict or inflation targeting regime, because you've given that. You've told it, and we all know that when the interest rate should be going down, we're going up, they basically lower it down. So that's another thing. Regarding the theory bit, now, Bo, you said about how it is actually different. Can you differentiate it from other uncertainties, if I'm not wrong? Is that what you wanted to?
That's one. I just want to understand. Actually, Aisha mentioned this, and I think Ines also mentioned this. So there is something that is unclear, because I think, one aspect is the distinguish between different types of uncertainty. And the other thing is that really there are some underlying theory that probably you did not touch upon.
Yes.
For example, why did I get an impression that this is a behavioral something?
Yes. So this goes back
to.
So
then you should mention this is, underlying theory. You can use the behavioral economics or behavioral finance to explain why did banks react in the way that reacted to this geopolitical risk.
Exactly. I mean, thank you. I'll go back. So this basically goes back, if you look at the papers by Adrian, so you can answer it from risk factors. So this goes back to Adrian and Shin paper, Adrian and Shin 2009, 2011, 2013, where they basically says that, when risk in the market goes up, so even if you have a interest rate, central bank lowering its interest rate because of risk perceptions among the bankers, they basically stop lending. So even if your balance sheet is at a very strong point, what I think Lucy was trying to mention, that the precautionary motive, or in other words, is basically the risk perception changes among the bankers. So that can be one thing. The other thing can be, it's basically going back to, you see, we have put capital. So it is basically actually like, and it is an exogenous shock, and it is affecting your buffer stock. Now, how much buffer stock? Because if you see the dates, how these shocks are coming. Now, shocks are usually one-off shocks. It happens in one period. But here, if you see in the case of Turkey, it's happening quite regularly. So if you take the cumulative effect of big shocks affecting the banks, then the capital buffer a bank has, it depletes. And that basically creates a pressure on the lending side, even though the central bank is, let's say, having an expansionary policy. But then the question is, look, I'm already constrained. I had a buffer stock, but it's depleted. How can I increase the lending? So that goes another side. Then again, Lucy talked about the financial risk premium. So, borrowers, if not only it can affect, if you look at the new bank lending channel. So, when you have a exogenous shock affecting the economy, it affects the banks and the borrowers. So if in the borrower side, default frequency goes up, and that default frequency indirectly affects banks. It makes the bank's balance sheets weak. Now, if you have a bank with a weak balance sheet, and you've got an expansionary monetary policy, the magnitude of the lending channel would be smaller compared to a bank who has a stronger balance sheet and is facing the same sort of expansionary monetary policy. So there is a theory bit. I think it's our fault. We should have explained that more. But thank you for your comments. Now, There was a last comment on endogeneity. And so now if you see, yes, endogeneity is a big issue. And this is one of the major contributions. Now, we use the mix variable, and the mix variable, we think that, takes account of because the mix is it's the ratio of bank lending divided by total lending, which includes depository institutions plus lending by non-depository institutions. So when you have a contractionary monetary policy, banks lose reserves, so the numerator goes down, but the denominator doesn't decrease that much, because it has been proven in the empirical literature that when you have got a contractionary monetary policy, banks are more affected than non-banks. So the mix goes down, so that loan demand and loan supply shift issue basically goes away. And then the other thing is basically, so we are identifying the monetary rather than using the reduced form shocks. We are basically using structural shocks. So the monetary policy shock seems to be fairly identified because we don't see any price puzzles, and the mix takes accounts of the identification problem. So does that answer the identification problem question?
I think, Rosen, you have actually covered quite a lot. Actually, I do not think the endogeneity is a big issue here, because you did explicitly consider that. So by I-way, by DDGMM, so etc. So for the sake of time, I would like to move on. Rosen, are you okay if I move?
I can say for 5 more minutes, basically.
Okay, so let's pick up another question, because I saw the hand has been there for a while. So Sulate, is that correct pronunciation? Sorry, you know what I mean, right? Sulate, right? Hello?
Yeah. I hope all is well. The pronunciation is Sulate.
Oh, sorry. Let me try. Sulate. The floor is yours. I saw your hand. Thanks for your patience. Please go ahead.
Yeah, academia is like that. You have to be patient. My issue is on, I have seen more focus is on geopolitical, which is right. But I want Lucy to enlighten me on how she was able to transition the macro data with micro data to help bring out informative contribution into the academia. Because what I know is that macro is to do with inflation etc. and usage of time series. Micro is to do with interbank banks in Turkey, as you are.
The connection, yeah. Sulate, are you there? Sulate. Okay, I think he probably is coming back, right? But Lucy, for the first issue, so how do you make those two levels of data internally coherent and to say the same thing? I get the impression that's the question, right?
Yes. Am I audible now?
Oh, right. Okay.
Yeah.
So
Yes.
can you finish, please? Can you finish, please, within 1 minute? Yeah, please.
Yeah, the second one was about what theory explains her study. Studies of this nature are anchored on a particular theory. Perhaps if you can divide into that theory and how her study supports or contributes to particular theory that is in question. And then lastly, the relationship among the variables has not been explicitly clear. The concentration has been more on macro, with limited attempt to answer the micro relationships in her study. I submit for now.
Thank you very much. I think those three questions are very relevant. So I think, Lucy, you are very patient as well. So can you please now pick up those response to those questions?
I think on the theory, I think we've just had a good overview of that from Rosen. I guess what I would say is that because our contribution isn't theoretical, I didn't spend a lot of time going over the theory, but the theory does exist. So I wouldn't want everyone to think that it doesn't, because I didn't spend much time on that in my presentation. I think that, it's all there, and in fact, you've got papers that do DSG work on this. So, you've got financial accelerator models, you've got the financial friction itself. I tried to emphasize when I was discussing it, the bank lending channel exists because of the existence of these financial frictions. If we make these financial frictions regime dependent, if they experience shifts, if the mechanisms themselves experience shifts, due to geopolitical risk conditions changing, then you have your theoretical basis there. And the reasons why they would shift are for the reasons that Rosen discussed. They're around risk pricing, they're around the precautionary motive. Our models can accommodate these things. They are, in some sense, behavioral a lot of the time. So the theory is definitely there. And what was the other question? Rosen, did you want to chip in there before you go?
So what was the question? Sorry, Sulayat. So what was the question regarding the data? Hi, Sulayat?
Yeah. So I think maybe his connection.
The question was your ability to combine both micro and macro data, especially when we know that macro data uses more of time series, while micro is more of creating a pan of several banks. By the end of the day, are you able to integrate the two different data sets, explaining different levels of economic development in a country?
So are you assuming that we have so look, the two data sources are taken from two different data sets. So you are right that we have taken the macro data from Bank of International Settlements and IFS. We have taken the bank level data from SNL. So they are two different sources. You are right on that. I don't see what problem. There shouldn't be any problem because, you can say that, okay, for time series data, you've used quarterly frequency. For the panel data, we have used yearly frequency. Now, in public domain, there is no quarterly data set available. Unfortunately, we couldn't find it for Turkey. So we had to go up with quarterly data from SNL. If anybody can tell us, a quarterly data set available for Turkish bank balance sheet data sets, that would be great, but we couldn't find any. So, that's the second best alternative. But overall, I don't see. But even within the panel data, the macro variables that we took, such as interest rates, GDP, we had inflation as an instrument. So the main macro variables are basically those that we take in the time series data. So should there be any discrepancy? I don't think.
Can I jump in? Yeah, thank you, Rosen, for that answer. I do not see any problem for you to use those two data sets. And so I would say it's good to check on the aggregate data level using time series, and then to provide some robustness test, if I can say, and to reach the same conclusion by using bank level panel data. I do not see any, but I think they did not merge those two data sets. They use the two data sets separately as a different set of empirical analysis, which is very good because nowadays the journals, they ask for a lot of different types. You have to explore the data as much as possible, as long as they are useful to reach the similar conclusion. So any other questions from the audience?
Actually, Hong, I have a final, as far as I understand from the comments of all participants, I think there is lack of, in overall, there is lack of clarity in the conceptual definition of geopolitical risk measure, which creates, ambiguity in your analysis. If you clearly define what you measure by geopolitical risk, because it combines two components, geo and politic. So if you clearly define the dimensions which you cover in geopolitical risk measure, and clearly define the channels through which BLC affects political risk, I think the work will gain more clarity.
I do take the point. And actually, I think it's interesting. If you look at the paper in American Economic Review, the 2022 paper, where Caldara and Iacoviello discussed their index and discussed the construction of the index, they acknowledged that this word geopolitical risk is actually a bit of a catch-all. It's something that is perhaps even a bit of an abuse of English. It's been discussed in the international politics literature. This word geopolitical is, as you say, it's a little vague. It's a little difficult to pin down. But they come up with a few definitions. And one is, this idea that it deals with international tensions or events or threats of events that would disrupt the peaceful course of international relations. So, yes, take your point. It's a concept that's difficult to define, but much like uncertainty itself, right? Yeah, I think any type of uncertainty, you run into this.
Thanks, Lucy.
Uncertainty is difficult to measure as euro. Yeah, Rosen.
Yeah, they basically look at 8 categories. So one is war threats, peace threats, military buildups. So military buildups basically can be within the country and externally. So if you're having a military coup, that would include into military threats, nuclear threats, terror threats, beginning of war, escalation of war, terror acts. Based on, so these are the things that they search in the newspapers or the news domains. So for the major news.
So in your paper, I think you clearly define these dimensions and include in your conceptual definition of geopolitical risk.
Well,
you cannot, instead of, okay.
I think, so I've got, I'm telling this from the Iacoviello's papers original website. So these are the 8 criteria that they look at basically.
Yeah. Yes. So thanks, Rosen, for further explanation. I think so Richard has comments throughout the internet. Sanctions. And those are so if you look at those comments, Lucy, so maybe they are related. But for the sake of time, I, as the chair, I have one more issue that I want to discuss a little bit further, and that is why Turkey. So I understand that you say, okay, Turkey is a very, to be honest, Turkey is a very special case at the moment. If you compare Turkey with other emerging markets, for example, and you see the high inflation and in the past few years, but Turkey probably was the only country that insisted on depricing the interest rate. So when everybody else has been increasing, after those shocks, the Turkish is going to another direction. And that causes a lot of problems, economic crisis, the devaluation of the currency, etc., etc. So I was wondering, how can you apply the conclusion of your paper to this situation? I didn't see any effectiveness of this monetary policy, to be honest, particularly during this the period that I'm not a research on Turkey, but I have been paying attention to that just because it's standing out. It is different. So how do you make the connection between your research today, your paper today, and the situation that is going on there?
Rosen, do you want to take it?
Yeah. Okay. Then Lucy. Okay. I'll start.
Yeah.
Then.
Well, I'm happy to. Yeah.
Yep.
Unless you need to go, I know you have your external examining.
Thanks, Bob. I was just wondering. Now, you are, it's a very hard question. But if you, again, this would be going back to look. Do you want us to talk about Turkish central bank independence? And because central bank independence is related to efficiency and it relates to the efficacy of monetary policy. So do you want us to talk more on that? Because if we talk more on that, then it basically goes into a totally another dimension. Because
I do not want a different dimension. If as long as you think you can answer, you can make the connection between your research and the practice in Turkey, and that will be very, very good.
Okay, so from what we have done, our short, that small research that we have done, is basically if you look at things, first of all these things, geopolitical risk, whether they're exogenous or let's say they are to some extent, they might be endogenous. Now, if they are endogenous, then yes, the thing can be serious. But the thing is that as long you are prone to these shocks, then monetary policy becomes ineffective. And you are truly right in saying that they have been behaving in a very unorthodox way. For example, when inflation, if you're an inflation targeter, if your inflation is going above the target, you should increase your interest rate. And Turkey is doing the opposite thing. And that has put havoc on its exchange reserves and all other things. Now, in our models, we are also saying the same thing. Look, when there is an expansionary monetary policy, your exchange rate effect on exchange rate value of the Turkish lira goes down. Now, if you continue to do that for, a certain amount of time, your reserves would go down, because what I think Mr. Erdogan wants is basically he had an election in front of him, he had the COVID, and even though the central bank was saying that, look, inflation is high, it's a typical time inconsistency problem. He was overriding the central bank and going for expansionary measure, which has created this havoc. And what we are seeing from our study is that although it's a different mechanism, but we do the work. It's in our slides. So if you keep doing that continuously, then it will have pressure on its exchange rate. Second of all, coming back to the bank lending channel, now look, whether these shocks are exogenous, you basically go into war with Syria, Iraq, or basically you don't solve your problems, internal domestic problems. You will be facing this shock. You'll be facing these shocks, and okay, sometimes central banks do reduce their interest rates to smoothen out exogenous shocks. But if they are happening at a continuous rate, then in the long run, because remember that the results from the short, we show the long run coefficients only. So what we are seeing is that if you want to stimulate bank lending, that wouldn't be possible. So that creates a really serious problem for the Turkish economy. So what we are saying is that you need to solve out these geopolitical risk problems. Unfortunately, geopolitical risks, central banks shouldn't be focusing on exogenous, especially inflation targeting regime shouldn't be focusing on exogenous shocks unless and until it affects the inflation. Now, in this case, one of the mechanisms, we are showing that one of the transmission mechanisms is totally switched off during, but there might be other mechanisms that might be working and that might work effectively. Does that answer your question?
Yeah, I think other mechanisms are very relevant. So because bank lending, what you are talking about probably is not the only mechanism.
Yes.
So at the same time, so there are some other things that is working. So let me look at the chat. I saw Jaideep, would you like to ask the question, or are you still around? Yeah.
Hi.
Hi, Jaideep. Yeah. It's my colleague here. Yeah.
Thanks. It was a very interesting presentation. But it looks like there's a lot of work done. I just have a quick question because I was a bit confused, with the whole focus on the identification methodology and so on. Whether there's actually whether it's clear for us to literally think about the monetary policy objective itself, and whether when there's a genuine geopolitical risk, is the objective function of the policymaker the same? And what are they doing in addition to just this kind of bank lending channel focused monetary policy? Are they doing other stuff that might have different implications? Identifying the counterfactual becomes a bit complicated when you're talking about a state of geopolitical risk as opposed to other types of exogenous shocks. So I'm kind of curious if there's a way to check for you whether these other policies that are implemented in parallel, resource allocation, all kinds of stuff happens at the same time. So there's preferential treatment of certain sectors. So is there anything that you can do to sort of resolve that issue?
I guess that's a different question, isn't it? So thanks, Jaideep. Yeah. So what you're asking is the central bank changing its reaction function in times of geopolitical risk? We have assumed it doesn't. Right. But whether it does, perhaps that's an empirical question. Rosen, would you like to?
Yeah. So, Jordan, are you asking for, rather than we using a linear identification scheme, so linear strategy function, use a nonlinear strategy function rather than a linear one, and incorporate geopolitical risk there? So in plain simple English, when the central bank is setting the interest rate, you want to have geopolitical risk as a x variable on the right hand side.
Sorry, my mic takes too long to unmute. So I'm not absolutely certain that by itself will resolve the issue. I mean, I just wonder whether there's because in the end, you're trying to look at a kind of a reaction.
Yeah.
And you're looking at a counterfactual. Underlying all this is the fact that basically what would have happened if there had been no geopolitical risk? But the problem is that's identifying that counterfactual is a challenge, because
we don't. Sorry, I'll stop you there. Sorry, yeah. Apologies. We don't do a counterfactual. This is all post. It's not a counterfactual simulation, by the way.
No, I understand that, but that's the question you're trying to answer, right? Isn't it? Or did I misunderstand that? I understand the methodology doesn't do that.
If you're asking from an empirical point of view, then you have to switch off the geopolitical risk shock. That would be a counterfactual simulation, right? So you switch off the geopolitical risk and then see what the bank lending channel was. So we're not doing that. We're doing it in a different way.
Yeah, I understand.
Let me, time is very tight now. So thank you, Jaideep, for that additional factor. Actually, yes, when we think about how banks are behaving, they are responding to the central bank's behavior as well. Central banks are also responding to what is going on in our daily life, shocks. Yes. So that's the channel. So I think that's additional. Do you need to, when you make your decision, do you need to consider your boss decision? And so that's basically very interesting.
The standard inflation targeter. Sorry to interrupt, Hung, but just
exactly. To be fair, I should have given a floor to Richard, but Richard put two comments here, and one is about types of uncertainty. So whether or not you talk about geopolitical, but what about natural disaster? What about the other political economics? Because they are endogenous. So geopolitical risk risk also affect the other uncertainties that are affecting monetary policy. So I think given the time, obviously, Rosen, our discussion has been so interesting that we kept you until the end of the presentation.
Yeah.
So I want to thank everybody, the participants who showed their interest on this topic. And thanks presenter, thanks Lucy and Rosen. Rosen, you have played a very important role in answering the difficult questions. So, and thanks for your contribution. And I think we should stop here. Normally, we have a cut exactly 3 o'clock. So thanks everybody. So I hope we can see each other in the near future. So I saw some hands. Yes. Okay. Thanks Asia as well. So have a good day, everybody. And Rosen and Lucy, thank you very much.
Thank you. Thank you.
Bye.
Having
Bye.
us.
Bye.
Bye, everyone.
Bye.